So housing starts in Canada appear to be sluggish for 2026. Yet, there is a boom in the construction industry. What's that all about? Let's find out. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk. Dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Véronique. How are you doing today, Vero?
I'm good, Mike. We just talked about training and how our muscles are sore right now, but I mean, it's okay. We can still talk, so it should be good.
I might not do this one standing up now that you're reminding me of this because my legs keeps on hurting. So for those who don't know, I started to work out with my son, who's 20-year-old. So obviously in a much better shape than I am. And he's just the type of guy, a bit like me, who tries to push the limit and enjoys that. So now I'm just destroying my legs or getting stronger. I'm not too sure which one is happening. So, anyways, so just talking for a while will actually be a good thing.
Yeah, sure. So, Mike, housing starts are part of the indicators of the state of the economy. Projections for the industry in 2026 are kind of more on the downside, which is sometimes a good time to jump in. So, today we'll discuss what investors should look for when it comes to the construction industry and whether there's a buying opportunity or not.
Yeah, I think it's going to be a very interesting show because we are not just going to talk about housing starts and home builders, but
Mhm.
taking a broader look into the overall construction industry, which includes like so many different types of business models. Of course, as usual, there are like plenty of opportunities down there. And it's just a matter of like which one you really want to pick. But by understanding the context behind it, it's going to be easier for you to make that buy list of yours.
And it's part of our daily routine, Mike, because your son is working in that field and my husband is too. Actually, they're doing the same type of job, so it's kind of funny. So in 2025, housing starts increased by about 5.6%. Expectations are lower this year. What is the context around the industry that explains this?
So we kind of have to separate the year of 2025 in two halves because the first half was very strong and the second one, I mean, not too strong. So what's happening right now is yes, we had like a lot of projects going on and funded also by government backed funds. That was the beginning of 2025. As we went through that year, we saw that there was a declining demand, especially in the condo industry. So we're building all those towers, but
Mhm.
eventually at one point, there's kind of like a limit of how many condos investors want to buy and if there's like any demand as well. We know that there is also a slower population growth that is likely going to continue in 26. There's a big break on the immigration policy as well. Cost of building thanks to inflation. I mean, we're not like federal banks stopped to increase their rates and they have started to decrease them, kind of like letting us know that, oh, maybe the inflation is like all taken care of. And yes, the current inflation rate is lower. I mean, we're not back to 2019 prices. It's still quite high. And now labor has kicked in, like all the materials to build has kicked in. So it's a lot harder. And of course, with all the tariffs and political tensions, well, that makes a lot of investors wanted to wait on the sideline, especially for major projects. They're just going to say, you know what, I'm just going to keep my cash and not buy a second or a third property at this point and see how it goes first. And then I eventually will go back in the industry.
Okay, so home builders and also a lot of other companies in the construction industry are part of the big industrial sector. They are also influenced by the materials because their profits depend on material costs. And in turn, they affect like consumer stocks and other industrials as well. So with that in mind, what should investors follow to get the best of the industry?
So, as you summarized it, it's a relatively complex business and quite cyclical, of course. So,
Mhm.
it's interesting to find companies that are getting beaten up with bad numbers because it's highly cyclical. So, it's going to go up, it's going to go down, and this is where you're going to have a chance. What I like to do, like when I look at the market in general, is to find companies where there's a negative sentiment, but the metrics are good, or
Mhm.
the company has like this robust balance sheet and is able to go through the storm and come back on the other side will with strong fundamentals, because you cannot expect all companies to always report revenue growth and earnings growth. That's just normal. That's
Mhm.
the name of the game. I mean, we were talking about working out before recording, and it's the same thing, you know? Like you're gonna wake up one day, you're all fired up, you hit the gym, and you're like everything goes well. And the next day you're just like don't feel like waking up at all. So it's the
Right.
same thing for businesses. You're gonna go through those cycle. What is important is not to jump into a positive narrative that is the only driver for an industry. And we're going to talk about a few narratives today. And don't get blinded by those companies that looks good on prom night. Just
Mhm.
put a little bit more context, because sometimes you're going to see like all the metrics are going up. So it's all green lights everywhere. But then you have to ask yourself, is this current situation is going to continue? Is this sustainable? Or it's just like what we just experienced with the COVID hype right after we reopened the gates, where everyone just thought, well, you know what, let's spend $100,000 in a home renovation and then revamp our entire home. I mean, once you do that, you're not going to repeat this 5 years down the road. You're still going to
Right.
enjoy your renovation, but that's going to be pretty much the end of it. So just make sure that you're not jumping into a short term wave, but focusing on the sustainability of the business. So maybe look at the past crisis or the past recession, so you can see if the business you're about to buy is able to go through that kind of storm.
Okay, and now what are the general risks of investing in home builders and the like?
So when you're thinking about the construction industry, of course, interest rate is like one of like the key factors. So when it's low, it's great because it means cheap debt. And of course, it's capital intensive. So you can borrow a lot of money, do your projects, and it doesn't cost that much. When interest rate rises, well, that's the opposite side. It costs more to build, but on the other side, you have fewer clients as well, because the consumer is going to get trap and will not likely want to get into a big mortgage as well. So, on top of being rate sensitive, they are, of course, cost sensitive. So, all the materials that they need, lumber, we can think of lumber as the number one, super important. A few others that are interesting as well is to keep up with the inventory, because once you build a project, you want to sell it as fast as possible. Because if not, well, you have some maintenance costs that are going to come in on top of like paying down that interest owed to the bank. The bank is not just going to say, oh, you don't sell your condos, don't worry about it. We can wait for a few years before you pay us back. So that is also another problem. Like I said, there is this risk of entering into a bull trap where you're thinking, oh, those are the good times, interest are lows, home builders are aggressively building new properties, new projects, everything looks good. And then you jump on that train, and then 6, 10 months down the road, while everything starts to slows down and that inventory is like built up and no one wants to buy your
Mhm.
project anymore. So you have to be very careful. If you're thinking about more industrial construction or infrastructure, there are like two other risks that comes into play. The first one is the backlog, because yes, backlog can tell you, oh, well, we have like plenty of orders coming up, so it's going to be great. We're going to have like a bunch of new sales. And then you're kind of like expecting a lot of growth that will be priced in the stock price. But the problem could come where some consumers are canceling, and then or their
Mm.
clients are canceling. And I mean, we have seen that with my son, who's working in the steel business, as you mentioned, where he was working to build a big manufacture plant, and they had like six stages at first. So they were like, "Oh, we're gonna be there for like 6 months, like easy." And then after a weekend, overnight, almost, they know that, oh, they're gonna just do like phase 1 and 2, and the phase 3 to 6 are going to be postponed to we don't even know when. And that happened during like the tariff announcements and everything. So the company was just like, you know what, we're just going to put a break on this. We're going to just build the minimum for now, and we're going to see how it's going
Hmm.
to happen. So those kind of stories happen all the time, but when it happens, well, that kind of like kill the backlogs right up front. The
Right.
second risk for long-term construction like this is the length of their contracts. And we're going to talk about a few companies that had problems with this. So when you enter into a multi-year infrastructure contract with the government or with a company, the problem is to not analyze the risk and the cost properly. So you bid for a price, you get the contract, and then you realize that it's not going as fast as you thought. It's more expensive. Like price of raw materials has been skyrocketing and you have not factored in properly in your contract. And by the end of it, you received a juicy revenue from that contract, but your margins got squeezed and now you're like not even profitable out of that job. So that could also happen.
And we've talked about AI recently. Mike, are companies in this industry in a good place to serve this tailwind?
So this is where it gets interesting, right? So while the housing starts is kind of sluggish for 2026, it's a whole new world when you're thinking about commercial and industrial buildings. The rise of AI will request a lot of investment in infrastructure, in the power grids, in power plants, and of course in data centers. So you'll need engineering firms, you'll need construction firms, you'll need like the equipment that the companies that are selling the equipment to for the construction, they
Hmm.
all benefit from this tailwind. And once again, this is where you have to be careful to not put all your money into this kind of play. Because as we mentioned in our AI episode, artificial intelligence has not just driven tech stocks anymore. It's a macro play. It's affecting a lot of businesses that has nothing to do with technology, but a lot to do with
Right.
infrastructure, power, and transmission lines.
So, the two real construction companies to discuss today are a Bird Construction, BDT.TO, and Acon Group, ARE.TO. What's to know about them?
Well, first, know that they're quite cyclical and they're not super large companies. So Bird
Mhm.
Construction is as a market capitalization under 2 billion. Acon recently crossed the mark of 2 billion market cap. So we're really talking about like relatively small businesses here. So Bird Construction, they are in the construction business and maintenance as well. They're operating coast to coast and they have several clients. They're serving like industrial, mining, institutional, retail, commercial, multi-tenant, residential as well, light industrial, and they're doing renovation also. They
Mm.
get a lot of contracts right now. There is a lot of growth coming from the defense sector, healthcare, nuclear, definitely related to AI here, and of course, data centers. So when you look at the dividend triangle for Bird Construction, what's interesting is, and this is why at DSR we show 10 years and not just like 2, 3 years of metrics, is the past few years are great, but way before that, like 10 years ago, the company was not doing that well. I mean, it was
Mm.
pretty much very steady, not growing that fast. No dividend increases for like a good 7 or 8 years. So you have to be careful that right now, maybe it just shows the best potential ever, but maybe it's going to stop very fast. So we see how the sentiment around AI in general is moving from like super greedy to super bearish, and we're not too sure where to go there
Right.
depending on the day. But that will also affect their ability to get more contracts for that too. For Acon Group, this one is also very volatile. At one point, a few years ago, they got into that problem where they had a lot of backlogs, great contracts, so the revenue kept on increasing, but earnings were going down. And this is where it raised a red flag. And now you need to investigate a little bit more. So what happened was really the cost embedded in the contracts, like they have not been built properly. So they ended
Mhm.
up completing some of their contracts at a loss. So for a few quarters not too long ago, they reported like big losses. So the stock went down, the stock went up. Now it's recovering again for that long-term infrastructure play, thinking about nuclear energy infrastructure, transportation projects, utilities expansion. So they are benefiting from that rise of demand for power. I would just be a bit cautious about those kind of companies. Yes, they look good right now, but they're small and they could get
Mhm.
affected quickly by a turn of event.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you. All right, so the next two are engineering firms, one offering better ratings than the other at DSR, dividendstockstock.com. So we have WSP Global and Stantec. What do you like about them, Mike?
Well, to be fair, WSP Global has slightly a weaker rating than Stantec because our angle is to focus on dividend growers.
Mhm.
And WSP Global has a perfect dividend triangle if you forget about the dividend. It's kind of ironic. So revenue and earnings keeps on increasing like quarter after quarter, year after year for a decade. But WSP Global decided to focus their capital allocation into growing by acquisitions instead of rewarding shareholders with a dividend increase. So, most of the time, when you look at a company that does not offer a dividend increase, there's trouble. But from time to time, there are a few exceptions where you find a company that is just a matter of like a different types of capital allocation. And this is exactly the case for WSP Global. So
Mhm.
on the pro side, and I'm a lot more bullish for engineering firm than I am for construction businesses. The thing is, they show perfect dividend triangle because they can work into different types of environment. So most of
Right.
the time, the engineering firm will help you not just to plan new projects, but to build them and then to maintain them and even get rid of those. So they are present at each steps. So we know that even if we are now in a big investment cycle where we invest in new projects, well, after that, you'll need maintenance, you'll need decommission, you'll need to replan the whole thing. And engineering firms are still going to be there getting those contracts as well. On the downside, there is definitely a war to acquire talent. Because, I mean, when you're thinking about that, there's nothing special about an engineering firm if you forget about their engineers.
Right.
So they need that talent.
Mhm.
It could lead to overpay for labor as well. And if you have like your best engineers that are leaving your firm because you're too small or you're not paying enough, well, then you can eventually lose contracts. So that's that's another problem. They're doing a lot of growth by acquisition for both Stantec and WSP Global. So there's always a risk of integration or buying way too many firms and thinking that you're going to create synergy. Well, sometimes it doesn't happen. And
Mhm.
still, it is cyclical. So while they have a kind of like an asset light business model where they can go through a storm, like it's going to be easier for them than a construction business, it's still going to be a problem. And from time to time, you're not going to get great results. Overall, when you think about both of them, I believe they're great investment on the both sides. I prefer Stantec. I have it in my portfolio just because it increases their dividend. But on the other side, WSP is about twice the size of Stantec. So if you want to go
Mhm.
for a leader in the industry, it's probably not going to be to go for Stantec. Both companies expect to grow their revenue and earnings high single digit to double digit going further, mostly because there's a high demand for spending into infrastructure at multiple levels.
Now, we can't talk about home builders without mentioning home improvement retailers like Home Depot and Lowe's. What's your quick overview for them?
So this is where it gets a little bit tougher, right? So we're going from like a tough spot to a great spot back to a tough spot. So for home improvement retailers like Home Depot and Lowe's, of course it's quite cyclical. What's important to look at is the same store sales. So this is because most of the time like their way to grow is to open new stores. But if your existing stores are not performing, well, then you have a sign that even if you open new stores, eventually you're going to fall into cannibalization and it's going to be a problem.
Mhm.
The average ticket size as well, the size of your bill when you get out of a Home Depot and a Lowe's has also a great influence. So this is one thing that we have seen after the COVID hype. So I just discussed that earlier today. At one point, everybody was doing home renovation and there was like big stuff. But now
Mhm.
over the past few years, management has noticed this. It's like, we have about the same volume of people that are entering into our Home Depot or Lowe's. But the problem is they have like smaller renovation. They're gonna paint a room instead
Right.
of like completely destroy it and start from scratch. So
Mhm.
you see slower dividend triangle. So revenue and earnings is slowing down. The dividend growth rate has also slowed down. So we're talking about like two long-term dividend grower, but now we are a little bit more cautious with our capital at those businesses. I believe that they are very solid investment for the long run, but you'll have to be patient. I do have Home Depot in my portfolio. I see it as a really long-term play because like from one year to another right now, probably not going to be amazing, but eventually the consumer is going to go back with major projects. The economy is going to start rolling again, and then you're going to reap some benefits of having those in your portfolio. This is always the tough part where you're buying a stock that looks like a decent deal. I mean, they're not completely beaten up either, but
Mhm.
then you enter into that phase where you have to be patient. Is it going to take 6 months, a year, 3 years? And I mean, this is where I don't look at my stock price most of the time. So I try to ignore that because if not, you're going to just say, well, Home Depot is lagging. Oh, Home Depot is still lagging. Oh my God, it's been like 9 months and it's not doing anything. I might as well sell. Well, if you do that, you're shooting yourself in the foot because you do not have a strategy. Your strategy is to follow the market, and God knows the market goes up and down all the time. So it's really
Mhm.
hard to keep track of what's happening. So instead of just trying to think, well, are we going to need Home Depots in the future? Is this business model sustainable? And those answers are definitely a big yes. So I'm just going to wait for the next economic boom to smile and enjoy
Mhm.
shares.
Then we also have companies, not necessarily in the same sector, by the way, but we also have companies like Richelieu Hardware, Fastenal, Finning International, Toromont, Packard. They all participate in the construction category. So, which ones are your favorites and why?
Yeah, so now you're like throwing a bunch of companies all over the place. Ironically, I bought a lot of stuff from Richelieu Hardware not too long ago when I was doing my home renovation. So in and out of the Home Depots all the time. And then it's kind of funny because you have like all those small things, like we're thinking about like the fixtures for cabinets, screws,
Mhm.
and stuff like that. They're all being sold by Richelieu Hardware. So when I was like looking at everything that I bought from Home Depot, a lot of that had the same logo and you may not even notice. So that's kind of funny. So Richelieu Hardware, they sell about 100,000 different types of stuff, all to home retailers mostly
Mhm.
in Canada and in the US. So very interesting play for the long run, definitely cyclical. But I like the fact that they're selling so many different things that they're relatively diversified, but the main narrative remains. If you have a lot of
Mhm.
construction and a lot of home renovation, then they're going to make money. If the economy goes into a recession, of course, it's going to be bad. Fastenal is I would say, a fascinating company because it's incredibly boring. We're really talking about nuts and bolts and screws. So definitely not something exciting, but this is what makes it exciting at the same time because they show a very strong dividend triangle. And their secret is in most manufacturers, they have their in store or their vending machine on site. So they don't
Mm.
have to worry about deliveries. They don't have to do worry about competition against like Amazons of this world. They're already on site and they have all the inventory that their client needs at any time. And especially, I mean, I was just doing home renovation at home and I was just upset how many times I had to go pick up something because those construction guys keeps on forgetting. It was like, oh, we need this. Oh, we need that. Oh, did you think about buying this? Well, it's exactly the same thing when you go into an industrial plant and then they need a lot of stuff to build their machines or their equipment. Well, they have it on site. And I would have gladly had a vending machine from Home Depot if it was possible at that time. That would have made my life a lot easier. So, Fastenal, very interesting business in the industrial, not just about construction though, but a
Mhm.
part of it is related to that. Then you go into the big Tonkas of this world. So, Caterpillar dealerships. So, you have Finning International, you have Thoromont, and of course, you can just buy Caterpillar right away on the
Mhm.
US side. I like those companies because while they are cyclical, they serve many different industries. So
Right.
you need those big equipments for construction, but also for mining, for oil and gas. So you need it pretty much everywhere. If you want to have a little bit more international exposure, you could go for with Finning because they have Western Canada, Latin America, and the UK. If you want to stay in Canada, well, then you go for Toromont Industry. And for Toromont, they also, one thing that is a big growth vector right now for them is their segment called Simco, which is specialized in refrigerators. So, like for industrial, thinking
Mm,
about arenas, but thinking about coolers for AI centers. So that is
mm,
also another great growth vectors, especially in the US for Toromont. So you have like those two plays. Again, if you look over the past 10 years, you'll see it goes up, it goes down. That's just normal. Right now, probably not the best time to put your dollars there, even though I bought Toromont Industry in my portfolio about 2 years ago. So I enjoyed a great ride. Right now, it's unclear if it's going to continue this way because the sentiment has been quite bullish around those companies. And then finally, you have Paccar, another one flying under the radar for many investors. They make trucks, like lightweight trucks, big trucks.
mhm.
And what is interesting is they focus on independent truck drivers. So that's 60% of their business. A great old vector for them with like more fuel efficient trucks that they're building. It's again highly cyclical, but they pay a special dividend. So you have your base dividend, and on top of that, every year you're going to have a special dividend based on that cyclicality. So I kind of like when management is fully aware of how their business model could be doing well or bad depending on how the economy
Mhm.
goes. And instead of like going for 7-10% dividend growth rate year after year, they do increase their base dividend, but then they will just give the extra cash once a
Right.
year depending on what happens. So when you look at the graph, sometimes the bar is really high, sometimes it's a little bit lower, but at least it's a good way to manage your capital for the future. That's an interesting play, I think, if you want to go more on the trucking business. On my side, obviously, my favorite one among that list is Toromont Industry. I kind of really like Fastenal. I've been following this one for several years. Never pulled the trigger. There's no particular reasons for why I haven't
Mhm.
not bought it. I mean, at one point, there's a limit of like how many companies that you can buy. And again,
Right.
there's still always some risk, right? So while they have in stores and vending machines, they also have to close down a few of like their standalone stores where they're making less money now due to fierce competition. And the other thing, like the other headwinds they're facing is they're signing major national accounts in the US, which is great because it propel your revenue growth. But on the other side, those national accounts, usually they want to have a rebate. So it's going to squeeze your margin a little bit. So you're going to get more volume, but on the other side, you may end up a bit less profit. So as you can see, nothing is 100% for sure. Nothing is 100% guaranteed, but there are a lot of opportunities in this field.
All right, so in the end, Mike, is it time to invest in the construction businesses or should investors dig into other subsectors of the industrial sector?
Well, I prefer to go wider and not
Mm.
always just look at a special industry to make it play because sometimes you can get wrong very fast. So instead of like expecting what's going to come up with a specific industry, I prefer to say, you know what? If there's something interesting in the construction slash industrial sector, well, I'm going to start with the dividend triangle. So, for example,
Mhm.
when I bought Stantec, it was not really about the fact that engineering firms are going to be involved in creating and supporting like the investment into power grids, transmission lines, power. It was more about, oh, the dividend triangle is almost perfect. They have a lot of different clients. They have long term clients, so clients that they have been doing business for like 20, 25 years, and they're growing by acquisition. With those acquisitions, what they can do is that they can do cross selling. So they're buying like new talents, new specialties, but also so they can offer those specialties to their existing clients. But by this acquisition, they can also buy book of clients where they can
Mhm.
offer their own services. So I was a lot more interested about the overall business model that yes will benefit from specific trends such as construction of in the AI space, the massive investment in infrastructure and so on, the like the fact that they're also in high demand for green projects, so projects that are more energy efficient, for example.
Mhm.
But at the same time, I just don't want to just surf one wave and hope for the best. So I like to be diversified in that space, and instead of like just going for a more aggressive play, I like to be a little bit everywhere. So, in this show, we have discussed a few of my holdings. Just want to repeat them in case you're curious. So, I do have shares of Stantec, Home Depot, and also Toromont.
All right, Mike, you've mentioned the dividend triangle a few times during the show, and we have an exclusive list of dividend rockstar that is based basically on the dividend triangle. Could you explain to listeners what they can find in that list and how to use it?
Yeah, so to circle back at the beginning of the show, where I said I love to find companies with negative sentiment but strong metrics, well, the Dividend Rockstar list will help you do that. So the list is based on companies that shows a positive dividend triangle. So positive revenue growth, earnings growth, and dividend growth. So when you have those three metrics, and of course, when you apply a filter, you're going to discard great companies and you're going to include bad companies as well. So it's not enough to just say, oh, there's about 300 stocks on that list. I can buy any of them, close my eyes, pick one, and it's going to be a home run. No, it's not, but it's a good place to start. So most of the time when you're thinking, oh, I want to buy something in the industrial sector, well, then you can filter by that. And then you add the sector plus revenue, earnings, and dividend growth. And now you have a set of robust businesses. And then starts your journey into analyzing a fewer number of stocks, but with a higher likelihood to become a great candidate for your portfolio.
So, listeners, you can download the Dividend Rockstar list for free by entering your name and email now at thedividendguyblog.com/rockstar. Thank you, Mike, for shedding some light on an industry often forgotten about, let's be honest. And TELUS is issuing its quarterly report next week. We will do a complete episode on it. Hit pause and the subscribe button underneath our podcast logo now so as not to miss it. And until then, stay invested.
Stay invested. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time.